No, no, you can ask me again. Sorry.
How basically the trading happens in the dealing?
In the dealing room.
Because in Murex we just see the trades and we are doing changes, these all things, that is fine. But the underlying how basically the trading is happening.
Okay,
what is the
fine.
link between say ABN AMRO and traders, sales, and then once the deal is moving into the Murex, how ABN AMRO is making profit out of the deals which are booked by the sales or the traders, and how we can see that in Murex? Is there anything margin or something like that on the trades?
Yeah,
I don't know.
No, it's such a valid question. In fact, this is where you should start. But before even you can go into exploring a particular application like Murex, Surface, Summit, Mises, etc., these are enablers. See, you're talking about two elements. One, why we drive, and what car do we use to drive. Let's explore the medium of transport later. But we should explore why we need to drive, why the transport is required. That is the first element, right? So your first part of the question is where you said why we have such a structure like a trader and sales and how they make profit.
Yeah.
It's a very good question. In fact, it's a very important question. So see, first of all, bank is a financial institution, correct, which has a certain amount of cash and assets in the balance sheet.
Okay.
So when a financial institution has a balance sheet, on the left hand side it has got an assets and some debt and some equity, etc. That's the balance sheet side of it, right? So the bank itself is classified or structured into several segments actually, right? You got the retail banking where you and me go to a bank, put our money, and that increases over time for a particular percentage, right? That is the amount you get it back from. That's a tiny percentage anyway, right? That's like the deposit. On the other hand, when you're in the need of the money, you take the loan out of it and you pay higher interest rate. That's the spread between the loan and the depot is what their income is for the retail. So more the volume of loans, lesser the non-performing loans, and higher the spread, more the profit for the retail banking. This is retail banking, such a simple division of banking, I would say. Then comes the corporate banking. Like let's say, what is applicable to you and me in terms of our transactions, risk appetite, our need of hedging, etc. is not same like you and me for a corporate. For a corporate, the needs and requirements are so different. Like example, you take a company like Adidas. Adidas India as an entity, a standalone entity. It has got orders or the materials coming from different countries, and it is also exporting to different countries.
Yeah.
So there is a back and forth movement of cash, materials, etc., and account receivables, payables, and tax, and their own tax, and where they invest the money, because the money is huge. For a corporate, the money is huge, and when they are in need of the money also, like a corporate loan, you need to work out the risk assessment as a bank of how much they should get, how much we should give it to them, etc., right? So the risk assessment, the credibility or the credit appetite, whatever, is different from retail banking to corporate banking. Correct. That's the second division or another form of banking. And then you have wealth management, kind of a specific, like a portfolio management for a big clients, a huge client, like let's say for even for a small municipal government, a bank like ICICI or HDFC will have a division to manage the funds for a municipal, because municipal does not handle everything in cash. Probably in India it's a combination of cash and electronic form of money, but the other countries, if you see, it's quite it's mostly a non-cash or electronic cash, right? Everything on the record, everything electronic. So there the functionality of bank is more evident actually, that they need a separate section to maintain the wealth and manage the wealth for bigger entities like that. So you've got individuals retail banking, you've got corporate banking for the companies. That could be a small company, medium-sized company, big company, and then you got extremely huge entities like the municipals, corporates, etc. Corporates, when I say, it's not the corporate company.
Basically, HNIs and all.
Yeah, HNIs, yeah, beyond that. So likewise, you have several classifications in the banking, but all these are working in a basic methodology of putting the money, taking the money out, isn't it? Either you Retail banking, you put the money or take the money out. Corporate banking, you put the money, take the money out. There are a lot of transactions for investment, etc. Because a corporate banking will yield to your needs as a for a particular company. But then what if you have, like, 10,000 crores in the balance sheet which is unused for a company, like let's say Reliance Industries, their wholesale banking partner is HDFC, but if they've got 10,000 crores sitting unused, actually HDFC will go forward to Reliance and say, you know what, I'm going to manage this by investing in something. Correct. Then comes the need for investment. Then sometimes the bank goes tells people, okay, can we invest this money because you have it unused. Sometimes it is the other way. It can happen both ways. And then sometimes it's a genuine need of a company that requires to invest money over a long period of time. Right? Like LIC, for an example, a very good example. It collects our insurance premiums, actually. What would happen to that huge pile of cash, unless everybody in the country is availing the claim, which is not the case ideally, right? There is just this insurance theory, right? 1% or 2% are only going to claim the money back. Anyway, the chances of the mortality, etc. Excuse me. So all through the time, whenever it collects the money, LIC or any other insurance company will want to utilize this money and maximize it by not taking huge risk, because you can't afford to lose entire money. If I'm LIC, I take money from you, I can't lose the money. I can't stand to lose the capital. I should protect my capital, still earn money. So there are norms created between LIC and the customers, actually, that LIC can do such investments, cannot do such investments, etc. So this is all on the record. LIC cannot go beyond that point. LIC even can acquire a company, a small portion of a company. Like today, LIC can have a stake in IDBI Bank. It is the case, 2% stake. So 2% stake in IDBI throughout India is held by LIC. Likewise, LIC have holdings across many companies, and foreign entities like LIC, like you have foreign insurance companies, etc. They also have holdings in India, subject to FDI approval. FDI, the slab, right? Not that a company outside can own Indian company 100%. That is like leaving it to an outsider to control your own entity, right? So if you take all these things in a different segment and how the transactions work, then comes the final segment, which is investment banking, which is what we deal with. Unlike other areas where the money goes in, goes out, money goes in, goes out, this works quite differently. Here, you work basically by taking leverage of certain assets. These assets are not real assets, these are financial assets, like interest rate, forex, and bond. That is again an interest rate product, but again, it's a bond. And then commodities and inflation. You see the connection between these four: inflation, commodity, forex, interest rate. What is the single connection that you see between these four?
Like if interest rate goes up or down, then simultaneously the inflation.
No need to get a cross synergy between the variables, but what is a connect? What is a common factor across these four? Because you could wonder why we stick to FX, why we stick to IR, why we stick to commodity and inflation, why not etc. Why there is a certain set of variables that we deal with when it comes to asset class. And then reason why I'm starting. See, I told you the banking, then I told you the divisions. Now I told you the IB, investment banking, and then now I'm coming to asset class.
Yeah.
And then I'll go to product.
Okay.
Then I'll go to structure of the bank, like trader and sales. That is the activity. This is the base. You see, designing a car, reading about an engine is different, but reading the theory of how Uber has evolved is altogether different. Correct? We are trying to put everything into a single discussion, but we'll have to take it in sequence. Correct? We should know first of all how a car works, why a car is required, how a car runs, and then think about how much load you can put it and how you run it, like whether it's a Lyft or Uber, Ola kind of services, or simply like your own car, right? That's it. So now my question is, what is a single common factor that you see across all these variables? Maybe I can tell
It
you.
can go up and down.
Yeah, exactly. That's the thing. That means these are not stagnant. You and me can trade on something. Like the basic definition or the theory of trading lies there. That is, anything in the humanity people trade is subject to move and not stay constant. If something is going to remain same value, why would you trade it? Why would you buy it? You would not. So these guys, financially, they have observed what things that move often or always is interest rate. It doesn't stay common. And then forex doesn't stay common, stagnant. Similarly, commodities and inflation. And they took these things as an asset classes. These are the assets. These are real assets. And this is the first reason why these are considered assets, actually, financial assets. If forex never moves, you're not going to make any product out of it. That's the first point. Second, there is a genuine need for an investor or a trader. There is a clear segregation between investor and a trader, I'll tell you later. But there is a genuine need for an investor or a trader to get protection from the adverse or even a small move of this asset class of a particular variable. Like IR, I have a huge position in Forex. I'm on Adidas Germany. I am exporting shoes to 170 countries, and there are some hundreds of currencies involved, and I get money in all currencies. And but finally, my balance sheet works in euros because I'm a European entity, German entity. So now what happens? I need to hedge my risk in all the currencies. Then there is a genuine need for me to work out a forex. Not only that forex moves, but I also have a genuine need. So what an investor do? He has a genuine need. What a trader does, even though he doesn't have a genuine need to protect, because it moves, he takes the position. Trader is somebody who's enabled with money to take position for profit purpose, even though he doesn't have a real basic need for protection. You don't need bananas. Very easy, very simple. You go to a vegetable market. You don't need bananas. But the very fact that you are saying banana moves every day from 10 to 15, then comes back to 12, and then 12 to 14, and then comes to 16, and then settle back down to 10, and you know some news is going to come that banana supply from certain country is going to cut short, and then banana prices will go up. Then in that case, when it is 10, you know it will go to 15, then you will buy banana futures, commodities, soft commodities, food commodities, right? Now, you really do not need bananas. But the very fact that you know it is moving up and down and somebody can give you money to invest, you're a trader. You're simply working out the movement in price to go and buy or sell. Or sell first, buy next. Or buy now, sell tomorrow. Whatever combinations actually. These are all methodologies actually.
So if I understand you correctly, then you mean to say that trader, his main business is to just earn money, earn profit.
Correct.
No hedging.
No, hedging is also part of it. Like the trader, he is the one who he runs the book where a particular asset class and instrument are maintained. The deals are maintained, right? So part of the deals are speculative,
Okay.
risky.
Happy New Year, guys.
Hello, happy New
See you
Year.
next
See
year.
you. See you next year. Part of the deals that he has are risky, correct? Part of the deals are because somebody else took a position and he has to hedge it on behalf of them, like a sales. Or when it comes to banking, there is nothing like an investor, sales, and trader. It is sales and trader. But in the real life, like you and me, can be an investor and can mimic what the trader does actually, right? For two reasons. So it depends on the entity again. I worked for a commodities company. They have a physical inventory of a particular commodity, like a soybean or a sugar, right? Now they deal with the physical commodity and they have the trading desk to which they will send this information and 1,000 lots, 1,000 barrels long on soy, whatever. Like when you say barrel, it is such commodity. Let's say oil. This trader now he is not going to take entirely a speculative position. He will consider that this is what my company is dealing with. Now I'm going to do accordingly, hedge it or add more, etc. He will technically he's executing some deal, but the purpose is something else. But just cut the scene to a bank where the same trader buying the future or buying a spot commodity, but there is no physical commodity stock for the bank, right? That is for the risky speculative bet, only to earn money through the price movements. Here, he will earn. He is protecting his investment. I am the physical commodity division head. I'm saying I'm 1,000 lots. I'm 1,000 barrels, and the value of it is like 1.2 million US dollar. What will you do? I have a holding. What if it goes down to tomorrow? So I'll go buy a put option on that commodity as a trader to protect it. I can have various methodologies. Not necessarily only put option protects you. You can even write a call option, short call, long put or a short call, whatever. That is a different subject, right? Product is a different subject. Structures are different subject, and the trading plus sales structure is different subject. When you get a doubt about how this thing works, first thing you need to know is there are like pies. There's different segments involved. If you understand separately, put the puzzles together, play pieces together, it aligns. So now back to our question. Trader either executes a hedge trade because there is a need internally in the in the institution for him to cover the risk, or he takes a position himself
To earn the
to earn the profit. But technically, you see the deal, you will not know why he has done it. Like the system wise, if I open Murex, unless he's provided some comments in the bottom,
So this is a hedge trade or
hedge trade or something, you don't know. But there is a segregation. He will book these two deals into different portfolios. Because end of year, if you have to work out your P&L, how would you do that? You can't have both deals in the same portfolio.
Yeah.
You will have 1,000 deals in hedging portfolio, and the accounting for hedging is different, and accounting for normal trades are different.
Okay.
That's a different street altogether. Yeah. So this is how the trader does. Trader, I would say, is the front face for the. That's why it's front face. Front face for the bank, investment banking. He is the one who executes big size tickets, like between bank A and bank B. Bank A has huge holding, appetite, risk appetite. Generally, bank has risk appetite than individual people. You agree, right? Than the normal people, than a company, right? Because bank can have surplus money and it can also rotate from other desks, etc. That's the point. It's nothing but a cash cow. Bank is a cash cow.
Yeah.
And not all the cash is used at one time for the real needs. The remaining ones, what do? Try to maximize it. That is where the need for investment banking came into picture. Where you will invest, you will not buy real estate and leave it. That has to abide by a lot of norms. A bank cannot own such many assets, etc. Illegally or legally, whatever. Then comes the financial assets. Among the financial assets, what are the ones that need investment and hedging, or what would need simply trading? Like you take a case of FX options, actually. It's not really much backing on the investment side, especially on the derivatives. This is how you can segregate it. All the derivatives are most likely are risk based, right? Or for the people who have more risk appetite, and for the plain variants of the underlying ones actually are probably coupled with the need actually, right? Now you can go asset class by asset class, but prior to that you need to understand the connection between trader and sales, which is what you asked, right? So let's imagine I'm a trader, you're a sales.
Sorry to disturb.
Yeah. Come Harshit, you want to ask the question about traders and sales? Happy New Year.
Happy New Year. Happy New Year.
Cheers. Bye. Yeah.
So before you explain that, one thing like trader, he's doing a trade. So if I look at any trade, so if I open that into Murex, I see that that trade has been executed between ABN AMRO and JP Morgan. So that JP Morgan is the counterparty. and between ABN AMRO and JP Morgan, the trade has been executed. So that the trader will book that trade between ABN AMRO and JP Morgan. So how means he will get to know that I have to book the trade according to that counterparty, or from where that need is coming.
So let me play this front to back, this deal, where it originates, why they have to do it, etc.
Yeah.
Right? So I would imagine myself as an ABN AMRO trader, and you are a JPMC person, right? I come in my morning, 8 o'clock.
And why he is trading with JP Morgan only?
Yeah. I'll tell you. I'll exactly play you the scene of this particular deal front to back. Okay? Right from the scratch. I come into I'm ABN AMRO trader. I come into my office 8 o'clock in the morning. I have nothing in my mind except that I forward some news in the morning, like in a Bloomberg or something, a Financial Times, or even from my local bank. There is a private podcast that is going on where I learn some of the variables are going to move, and there is going to be some announcement from the central bank of that particular country at 11 o'clock. See how many things are influencing me as a trader already. I have a mandate from the desk. Desk has its commentary. Every day when at 7 o'clock the desk starts trading, there is a gathering among the traders and the trading head who says, this is what is happening today. Because how would every trader will come to know exactly the same thing? There can be 15 traders and 15 junior traders. All 30 gather on the floor and the trading head gives a commentary. I've seen these commentaries, that's why I'm telling actually. I've been part of the commentaries, like as a shadow. They say this is what has happened. There is something written in the blackboard and everything. ECB is going to announce this thing, and there is going to be an announcement coming regarding Brexit. That means you are expecting a huge move on GBP. Right? And then US Fed may or may not hike the rate, and there is a 10% chance. And what we think already as a bank will happen. It's not only saying what is there, it's also telling traders what we think based on what we know. So that what you can
basically can
happen. I have to enable you as a trading head. I'm not supposed to read out what has come in the paper. I have to tell you, unless I tell you, how would we know what is our direction of trading today? We will tell you, like, Fed is going to increase the rate, the Fed funds rate. I believe 90% chances for 25 basis point rate hike. As a bank, we believe there's nothing like but our bank believes there's going to be 90% probability of getting the rate hiked to 25 basis points, and there is only 10% chance that it will be raised to 50 basis points. Trade accordingly. Now, all 30 people align to this, right? This is so important in the morning. This judges the direction. And as you do it during your day, the way you do it, etc., of course, there is a supervisor who monitors. That's why you have supervisor sessions, trade supervisors, not the supervisor in the Indians, IT, SP2 sub kind of things, right? Those supervisor sessions, you have it to monitor what traders do, their positions, their P&L, are they in line with what we told? It's not that you leave them blank. It's not that you give them everything, but you
give them
guide
direction.
them. Exactly. You show what direction is important for us to do. But previous day, regardless of these directions, your trader A and there is a trader B. Trader A is plus 20 million P&L. Trader B is like minus 30 million P&L. He has a different way of going through the market. He has a plan. Yes, as of yesterday evening. You have a different plan. You can follow the direction. May not be him. That needs a personal interaction, right? That will be second session. They would come to say, see, I'm short 30 million, but you want me to trade this way? I can't go long all the day. I have to short again. He would argue. Then someone has to, explain him why not, why. All these things will come into picture. This is how trader will stick to a bank or not. If his views are considered, if he is successful throughout his life, then he will stick to a bank. If he is successful, if the trader is not successful, unlike in any other career, the trader's career is very short. It is fully quantifiable based on the P&L, end of year P&L, at the start of year P&L, whatever, end of year P&L, of course. Trader will himself know whether to stick to a bank or not based on his P&L. He won't wait for the head to tell him. It is evident, right? It's nothing like a performance appraisal. If you're long, if you're profitable, it's fine. If you're not, you'll make a move. Either the strategy of the bank didn't work in your favor, or your strategy is not agreed by the bank, whichever case. But it led to a loss, and once or twice they can afford to leave, hold you with the loss, but then they can't, keep you on board and increase their losses, right? This is how it is, and they will recruit another trader. Okay, now the point is back to our scene, this avian amro, like let's say this guy, like, so he read some news yesterday. See, from previous day close, as a previous day close, he announced his P&L, went home, accounting run, end of day reports run, risk reports run, everything is fine, and even the value at risk is reported to the regulator, etc. Today morning trading started. The variables start jumping. It's like 5-6 balls, they always keep jumping, but your position is like that. If they jump, you go up. If the upper one jumps, you go down. So this variable keep moving, your positions is also like fluctuating like a fish, right? But now he has gone through this commentary. He read the podcast. He went through the podcast and everything. Now he knows the direction of trading for today. And the announcement may come in favor and may not come in favor. Not every day is going to go for an announcement anywhere. Right? It doesn't deal with that way. But in a normal day, let's say, he has his position, he has this commentary, he has his news and everything. He is influenced by all this before making this deal. And he would watch an application like Murex or whatever, Summit or whatever, and see, this is where I am. And if 1% of the rate is hiked, moves up, 1 basis point, not really 1%, 1 basis point, which is like 0.01% hikes, how much P&L I will end up with. That is what the DV01 will show. The sensitivities will show him when these variables move. You may have 100 million P&L, I may have 200 million. When the variable moves just this much from A to B, impact on you will be different from mine, right? Isn't it? That impact projection is nothing but sensitivity. Gamma, delta, vega, whatever, volga, everything, rho, whatever, interest rate, volatility, spot rate, etc. Now 4 things together. Yesterday end of close, his positions. Today morning, his own reading and his perceptions about trading, and the commentary, the influence of the commentary, and then comes what is there on the screen. Now he would have several requests for quotes, either mails or chats in Bloomberg or calls coming to him, because he's a big bank. They would show a quote, like if they're ready to sell 10-year bond. It's not like you will wait for somebody to come and ask you, can I buy? How would they know? You will go make an offer. This is what offer and bid. The market works actively because even if there are no buyers, the sellers are active. Like coming and saying, I have it, who needs it? It's like this open cry, outcry, who needs it? Then every time you shout it, then all the other buyers, even let's say there are 10 shops, 10 banks, 10 shops, 10 banks, each has different assets of different sizes, of different prices, of what they bought. Now all 10 shots start shouting. The first shouts that I have a bond 10-year at this much price. It won't vary so much because there is always a benchmark closed, right? If the 10-year US Treasury benchmark bond closed at 101.30, you won't be selling at 107 or 97. You'll be selling with a bit of a spread, right? You move with the supply and demand. If there are more people coming, 101 become 102.5. That's a huge move for a treasury, like a security. If there are less people, you will not move it up much, right? You can't move it up much. That's a supply demand thing. So already this trader has a lot of quotes. Are you willing to buy? Are you willing to buy? And then if he has a need to buy the 10-year treasury, among the 5 quotes, he will pick the easiest one or the cheapest one.
Okay, so suppose he is a trader from ABN AMRO. So he will.
One of his bids is from JPMC. One of his.
So
he chooses it, and he would call him, and sometimes not necessarily. He would call him and say, "Hey, JPMC Jason, how things? So are you ready for 102.35? No, mate, I need 102.40. Let's work out 102.38. Yeah, I'm okay with that. I'll give up my two points. Executed. And the moment he executed, he has to accept it on his screen. Accept. This is what Bloomberg is designed for, like Bloomberg kind of channels. We talk, we chat, we express interest. We call, we confirm it. We type and execute, we get the affirmation. And once it's affirmed, then the trade flows down to Murex in the bond. Likewise, you have different asset classes, different behaviors. Maybe we can discuss this later. Just grasp this first.
Yeah.
Slowly. If we discuss everything together, we may not be able to. But you're getting the picture.
Yeah. Many things got clear till now.
Okay.
Yeah.
What questions you have particularly?
So this one was like like we see the trade like it is between two entities. Means two entities, I mean like two banks, ABN AMRO and JP Morgan. So the question was like why I'm doing the trade with JP Morgan, because I was not aware of the process itself. Now when you told that as a trader, if I go, then I see several quotes. Now there are 7 to 8 banks. They're willing to sell some financial instruments.
That is what the liquidity, because for 10-year treasury bond, US dollar, you will have 100 banks giving quote, because that is a very, very important benchmark security in the context of market, right? That is like a credit risk-free one. US bank 10-year bond. I mean, that means whatever money you keep it with US for 10 years is sure to come back with more money. That is what the underlying meaning is. That security everybody wants to buy. If somebody says Greece 5-year security, 10-year, no buyers. Because Greece is in trouble. Then you will not have the same amount of RFQs. Or even if there is 1 or 2 RFQ, the spread will be so high. You may have bought it yesterday at 70. Today somebody is giving you a quote at 55. Can I get it 55? Oh my God, I have to sell at loss. So if you're with the right security, right liquidity, things work in your way. The spread wise, I'm saying.
Yeah. So looking at those things, like what are options I have from the different banks, then I will see what is my like suppose if I have bought some financial instrument at 50 rupees, so definitely I would like to sell that at 50 or more than that. So I will just see and then I will decide, okay, this is JP Morgan giving me at 50 or 60, then I will do. So if I do it at 60, so I make a profit of 10. So that is my spread. So that is basically the margin in the product in Murex VC.
So you're see,
like any trade that is being executed, a bank executes, they will not do in loss. There will be some margin.
No, margin is a different concept. Margin is between sales and traders. Okay, as a trader, I'm specialized in managing the risk across asset classes, right? And hedging, etc., etc. Because I'm the front face for the risk management, taking positions, hedging it, etc. I'm the showrunner. But I can't go to 500 clients, 5,000 clients in the country and convince them buy the product.
By clients, you mean JP Morgan?
Customers. No, not only the banks. All mini clients, small clients. Like let's say there is a tea company. That company has a real potential. Who connects that company to the trader? Trader is always busy tracking the variables in the market. He can't call every single customer, 5,000 customers. He can only entertain big banks. That's why trader is involved in bigger discussions, bigger clients. The size of the ticket, where every channel is fully active between him and the client. But there can be clients in the country, in a particular country and a particular sector, who really needs to involve in the products actually, who are willing to take these products, buy and sell the product, but the small sizes. JPMC will place an order for 5 billion. They have an appetite. You have an appetite. But a small tea company will have an appetite for 50k. If there are like 5,000 people for 50k, would trader take all the call, execute all 5,000 deals? That is where the sales are included in the bank. The need for sales comes. Meaning, sales are always segregated based on their expertise on the field, on the sector. You are a salesperson. You are specialized in covering commodities clients. I'm a salesperson. I'm specialized in covering, let's say, tire companies. That means I can only focus on tire company clients. You will only focus on. So I'm tire company clients from Tamil Nadu. You are a commodities sales person in Kerala. So you would know the field well. players well, clients well. Now you will internally and personally connect with all the clients and then explain the products which trader is trading to those clients. And they are already customers for the bank anyway. It's not that they're on the remote place, not connected to the bank at all. They're availing the services of the bank like retail banking, commercial banking, consumer banking, institutional banking, wealth management, whatever.
By the clients, you mean suppose if I take the example of SBI.
No, see, banks are different. Banks can be part of the client space.
No, if SBI is a bank, so clients may be like ABC Corporation, a small company, and which is like exporting some things to China or something. So that will be a client. And that client, because he is export business or something, so
yes,
incoming and outgoing
need for the
he's in the need of that FX
hedging, whatever. Yeah.
So he will now the sales of SBI, sales team of the SBI. He will be in touch with that client.
Correct.
And he will try to make him understand that this is a product.
Exactly, like if there is a funding swap. Funding swap is a product designed with financial knowledge and quantitative analysis. It behaves in a particular way. Put A, you will get A1. Put B, you will get B1. That is how the product is defined. But a normal client will not know this terminologies. What his payoff will be. If he is agreeing to take the deal, how the payoff will change, somebody has to explain. So someone with the product knowledge, but somebody who's not as busy as trader should deal with that guy, not only deal with convincing or canvassing to buy, but supporting throughout the deal.
So he will go and he will talk with that.
He will bring either the guy who can visit the bank, or he will go with a lunch or something.
But they will finalize the price. Correct. Like I will give you.
No. The price is not finalized there. Product explanation, everything is done there. Then you are onboarded as a proper client for the sales. Okay. With the sales member tagged to you.
Okay.
Next time you want to execute something, you tell me on the phone or whatever, chat or whatever. As a salesperson, I'll book the deal in Murex or in upstream systems with you as a counterparty, with my name as a sales for a particular price. What price? Let's say 100.50 with you. I will go to trader and say 100.40, are you ready? I will not tell how much you are giving it to me.
Oh.
I will
even though
no. See, trader, if he has to sell something, he can only do it for 100.40. Either he executes or he executes on behalf of sales, whatever it is, hedging. He's okay with 100.4. See, I bought this for 100. Now, if I sell this, I'll sell for 100.5. Whether sales involved or not, I'm okay to sell this for 100.5. But on the other hand, sales will convince the client to give additional money. That additional money is called the margin.
So suppose 100, I'm the counterpart, ABC, you are the salesperson. So you decided with me, suppose I called you and I say, okay, I'm fine with 100 rupees. So you are the salesperson, you will call to the trader. This is the product. And
first I will connect with the trader and say, are you okay for a 10-year treasury buying at 100.4 from me? 100%, I'm okay with that.
100.4 from you?
From me, from sales. He will not reveal the client.
Okay, he will not reveal the client. Okay.
Yeah. Okay. The trader is not supposed to know how much I'm making. That is an integrity breach.
But if you can book the trade in Murex, then why are you asking from the trader?
He has to cover the risk. I will not monitor the market.
Okay.
I will not monitor. And that 100.4 I am catering to the customer, right? Who will get the security for me from the market? By talking to banks, big institutions, etc. etc. It is like selling some sweets or something. Somebody has to make the sweet, hedge the sweet, etc. etc. Here only you are agreeing to exchange the sweet for a particular price.
He says like, okay, he is fine to buy from
proper commission business is sales. Taking the margin. Better the sales convincing skill, better the convincing skill, higher the margin.
So you decided with me 100, you talked with 100.5 with the trader. He said, yeah, I am fine to buy. Then what will happen after that?
Yeah, I'm buying it for 100, I'll give it for 100.5. There are two deals involved in that. Sales. Client versus sales versus trade. That's why it's a back-to-back deal.
Okay, this is called as back-to-back deals.
I understood.
Okay. So back-to-back deals will come only in the case of this sales.
No. This is just one example of back-to-back. There are many back-to-backs which we will discuss.
Okay. So you will do one trade with me in Murex. You will execute. You will type as a trader, and then
as a salesperson. As a salesperson, you will not type the trader name. Either you will keep the trader name, or you will even put the trader's book portfolio.
I have seen like in Avian, it used to show sales. That if you open the deal,
this is all actually your pre-trade routing rules and lookup table. These things will take care of it. Even STP rights, etc.
Okay. So one trade is between you and me, and another trade is like trader and yourself. Sales.
That is the risk deal. This is the client deal. This is what will be settled with client. This is important. This deal is important. What we settle with the client is important.
Yeah.
But sales versus trade is an internal deal, right?
That margin, that is your profit.
That will be there in my portfolio. Anyway, buy 100, sell 100.5. So 0.5 into 1 lot is 1,500,000. 5,000K is my 5. Yeah. So by looking at my book and for the throughout the year, I will know how much money I made as a sales.
Yes.
See?
Yes.
So the number of traders involved in a bank versus number of sales, there is a huge difference actually. If you have 5 traders to 10 traders, you can have 50 salespeople, 100 salespeople. Depends on the size.
Many things got clear today.
Yeah. Nice to know that actually. You can ask more questions if you want, like a specific example, etc.
I think you
but
are,
this is
you are here till 31st.
Yeah. 1 moment.